Good evening, VV Nation. Ron Wheeler here, manager of options trading, and it's my pleasure to bring you tonight's special presentation, 5 steps to generating income with options. First off, let's talk about income. What exactly is income? Well, income would be a paycheck, whether it's from a company, maybe you collect Social Security, a pension. An income is simply something you collect on a routine basis. In the investing world, an example of income would be a dividend. You buy a stock, you get paid a dividend no matter what happens to that stock, as long as you own it, you get paid. Now, in the investing world, buying a stock at 100 and selling it at 105, while that is profitable, I don't consider that truly an income trade. To me, an income trade is one where you build probability into that trade. That way, no matter what happens, just like a dividend, if the stock goes up, you get a chance to get paid. If the stock goes sideways, you still have a chance to get paid. And even if the stock goes against you, you still have a chance to get paid. That to me is what I refer to as income trading or income investing. Now, why is this such an important topic? Well, our goal here at VectorVest, the reason why we do what we do is so you can be free. You can be free from worry about where money will come from when you're retired. You can be free to do what you want with your free time. That's why we do what we do. So the next question is, how do you do it? One of the best ways is to use options for income, and I firmly believe it can change your life and set you free. Using options the right way, you can make consistent income each month, and that, I mean conservatively 3% return on average every month. Now, why doesn't everyone do it? Well, most people are afraid of them. You might even be tempted to stop watching because I'm talking about options. Why are people so afraid? Well, you might have been told that they were risky, or you needed a lot of money to trade them, or maybe you needed a lot of time to do it. And all of that is false. Maybe you find them confusing or difficult to understand. Okay, well, that I can understand. But I really think it's because you haven't been taught the system or even a system in a way that makes sense. But ultimately, here's the thing, you don't have to be afraid, and you certainly don't need to be confused. Here are some of our clients who are just like you and were in your shoes at one point, who have changed their lives by learning to use options correctly. These people are real people, and they are just like you. Now, in order to do that, you need to avoid the common mistakes that people make, and perhaps you've made in the past when it comes to using options for income. Now, as we go through these, we'll talk about how you can immediately fix them. And at the end, I'll show you the 5-step system I use to trade options for income. Now, mistake number one is simply being on the wrong side. If you're trying to generate consistent, reliable income as an option buyer, you're just on the wrong side. Option buying has its place, especially if you know how to do it the right way that we teach it. But most people don't, and you're going to take advantage of that. Most option buyers have a buy and hope strategy. If you're buying and hoping that things will go up, you're basically gambling. This is why people lose more than they win. And it's a big reason why many people give up on options trading. But if you have a system based on selling options for income, you can reliably generate monthly income. And instead of losing more than you win, you can turn that around and have over a 70% win ratio. In fact, many of our clients are averaging higher than that. Now, I want you to think about it this way. A stock can ultimately do one of three things. It can go up, it can go down, and it can go sideways. So let's say you buy a stock or call option. In order to make money, that stock needs to go up. That means you can only make money in one of those three scenarios, which also means the seller of the option would make money in two of the three scenarios. This is an example of a stock take two, and it's the current stock that I'm in that I'll show and we'll talk a little bit more about as we go through the presentation. Now, there are three main parts of an option that I want to talk about. There's the expiration date, there's the strike price, and there's the premium. In other words, the price of the option. For every option trade, there's going to be a buyer and there's going to be a seller. Now, as a buyer, the expiration date works against you. You have to be right by a certain date. And every day, a thing called time decay eats away at your option. Now, the strike price is something you need to overcome. The stock you pick has to go in your direction for you to be right and make money. The premium is something you pay to someone else. That's money out of your pocket and right back to that buy and hope mentality. Now, as a seller, the expiration date works for you. Every day that goes by is more money in your pocket. The strike price, something that's easy to avoid. The premium is something you receive, so you ultimately get paid to trade. Now, the key takeaway here is this. Being an option seller gives you a higher probability for success. Now, I'm not saying you should just go out there and sell any option and money will just fly into your bank account. Instead, I'm saying learn to sell options correctly and you start the trade with an immediate advantage. When you sell options the right way, you start off the trade with a minimum of a 70% probability of success. Now, keep in mind there's more to the system, which we'll talk about when we get to mistake number 4. We don't want you to just go out and start selling naked options. At this point, I want you to understand that you have a higher probability of success as an option seller. Now, one of the best baseball players of all time was Tony Gwynn. Not because he hit a lot of home runs, but because he got a lot of singles and doubles. He hit for a high average. When you always try to hit a home run, most times you swing and miss, then strike out. And most option traders are the same way. They buy cheap options, hoping to hit a home run. What ends up happening is they suffer small loss after small loss after small loss, eventually draining their portfolio. Now, here's that same graph of take two, TTWO. To get these cheap options, what they typically do is they buy an option with a strike price that's really far away from the stock price. In order to make money, most times the stock would need to make a significant move in their direction. Okay? Now, since there are buyers out there who are willing to buy those call options way up here, you're going to be the one who sells it to them. You are selling a low probability option that has a low chance of getting hit. There's an over 70% chance that that strike, in this case 132 or 135, is never going to get hit. And that's just based on probability. And the same ultimately goes for puts down here. Since there's buyers out there willing to buy put options way down below the market, we're going to be the one who sells it to them. Again, you're selling an option that has a low probability of getting hit. And again, just to expand on that, what I mean by getting hit, the stock's at 124.72. If I go out there and buy a 135 call, if I say it gets hit, that means the stock rises to 135, or vice versa down to, let's say, 112 on your put. So the key takeaway here is this. Start by selecting a strike that has a low probability of getting hit. Mistake number 3 is not having protection. Remember earlier I told you we didn't want you to just go out and start selling options naked? Selling options naked means you don't have a way to limit your risk. It means there's no other trade along with it to protect it. And if you sell options naked, then you take on more risk that we don't advocate. We want you to be risk adverse. So instead of selling an option naked, you should buy an option along with it as a way to protect it and you and limit your risk. I want you to think of this like an insurance policy. Now, here's an example. First, remember the system you use ultimately determines how you reduce risk, and this is all done before you open the trade. The first thing you should do is choose a stock that is low risk. We have a very specific criteria for picking good stocks. Now, once you do that, instead of selling naked, we are going to sell with protection. So let me show you how this is done. This again, we're working off that graph of take two. It's a trade that I'm currently in. The date or the stock, though, really doesn't matter. I want you to understand the concept of what's going on here. This is a graph that I found using a VectorVest search, a good bullish search. So instead of just going out there and buying shares or buying a call, you're going to do this. We're going to pick a price underneath the current stock price. And in this case, I chose 120. Okay? When I sell that put, you take on an obligation to buy the stock at this price, which is fine because you're bullish and you're willing to buy the stock anyway, right? Well, when you sell the put, you receive a premium. You're getting paid. Basically, that would be a naked put and leaves you no downside protection in case the stock drops. So what we do and what you should also do is use a built-in protection plan to protect yourself. You're going to simultaneously buy a put down here as insurance. Now remember, when you buy a put, you now have the right to sell the stock at that price. Worst case scenario, the price drops to maybe way down to $100 a share overnight. But since you bought this put as protection, you are protected. So think about this, right? Let's say that the unthinkable happens. I have the obligation to buy the stock at 120. It drops to 100. Uh-oh, now I've got to buy the stock at $120 a share instead of 100. Well, the worst case scenario is I can turn around and sell it at 115. Now I want you to think about something here. That's what could happen. In over 15 years of doing option spreads like this, it's never happened to me because avoiding that is part of good management. We'll talk about that a little bit later. Now, that protection plan does cost something. To buy that protection plan, you need to use some, but not all of the money you receive from selling that put. And that leaves you with a net credit. That means you got paid to place this high probability trade. No money out of your pocket. Now, this type of trade is called a credit spread, and it's an amazing way to generate consistent cash while limiting your risk. Now we've got a stock at 125, and as long as it stays above 120, I'm profitable. So the key takeaway here, use a credit spread since it has a built-in protection plan. Now, on to mistake number 4. Another mistake is not putting time on your side. Another way option buyers get those cheap options is they select expiration dates that are too close. It's like the options are like meat in a discount rack. It's cheap for a reason. It's going to spoil. They're going to go bad very, very soon. Now, here you see what happens to the price of an option in relation to the days of expiration. Notice, in the upper left to the lower right, we're looking at a 180-day span. Over 180 days, take a look at where the big drop-off starts. Right about here. All this room over here, the option lost about half its time value. Over here in the last 45 days, it lost the remaining 50%. Option buyers love these remaining 45 days because premium is very inexpensive. What we're going to do is we are going to sell our options in that window. More specifically, in a 21 to 45 day window. That's the sweet spot for where we want to sell our options. The key takeaway here is options decay quickly in the last 45 days. We're going to sell options that have an expiration date 21 to 45 days away. That way we're still capturing a good amount of premium and not increasing our risk too much. We're going to let the buyers do the hoping and praying while you collect little mini deposits each day as the option decays. Now, mistake number 5 is the deadly combination of greed and hope. On one hand, you have greed. A dangerous thing option sellers say is this: I'm up 50% on this trade, but if I just hold it a little bit longer and let it expire, I can make the full 100%. One of the worst feelings is to watch a profitable trade turn around on you and eventually close it for a loss. Well, on the other hand, you have hope. An option seller will see a trade going against them and say, well, probability's on my side. I'll give it one more day, it'll come back. But when it doesn't, they watch that small loss turn into a big loss. So the takeaway here is this: set your profit target immediately after you enter your trade. By placing your profit target order, you eliminate greed, and you can walk away with a profit that you are happy with. Now, history has shown that taking profits right at 50% of the credit received on trades like the one I showed you has shown to provide an increased percentage of winning trades, more profits. Yes, you actually will make money, more money taking profits at 50% than 75% or 80% or 90%. Don't give that stock, don't give that market time to turn against you. Many investors are used to trying to squeeze out every penny of profit only to have that trade turn around, and they're left holding options for a maximum loss. So key takeaway again is exit if the stock price goes against you and hits the option strike price you sold. So let's take an example. Let's take a look at both of these takeaways. Now, what you're looking at here is an actual risk graph of the trade on Take-Two software. Now, I don't expect you to understand the risk graph perfectly, but here's what I do want you to understand. See this line here? This one. This is the only one I want you to take a look at. I'm just going to put a little line on it. If it goes into the green section, that's good. If it goes into the red section, that's bad. As the stock goes up, this is the stock price at the bottom. As the stock goes up, I get into the green more and I make more money. Now, here's what you see in my broker for Thinkorswim. I actually have an order placed to take profits at 73 cents. I sold the trade for $1.45. I have a profit in there of 73 cents. I can now walk away. Now, if you're looking at the risk graph, I want you to look at one other thing. Over here, you might see that my maximum profits are $15.95, and you may see my maximum risk is $3,900, and you might think, wow, that's crazy, right? Well, remember, we're going to exit this trade if the stock falls below 120. And again, if you follow this line right here, this is the line. I know it's not perfectly straight. Sorry about that. But if you watch that line, this right here is where I will exit the trade. And that loss is basically $700. So in a nutshell here, I'm looking to make around $800, and I'm risking only $700 to do this trade. And you might think, well, Ron, what happens if the stock gaps? Could you lose a little bit more? The answer is yes, you might lose a little bit more. But to lose $4,000, the stock would have to drop in a single day way below $100 a share. I've never had that happen, ever. I've never taken a maximum loss on any of these trades in the 15 years that I've been doing it. Now, I'm going to give you the 5-step system I use each week with my clients. We call this the options paycheck system, and it's what helps us stack probability in our favor. At the top of the system is market direction. A lot of traders ignore this and they just go out and start placing trades. You're going to be placing trades that are either bullish or bearish, never at the same time. By doing this, you're narrowing your focus. Instead of looking at everything, you're only looking at one or two possible scenarios. The paycheck system has a market timing signal built in that helps us tell the market direction. Now that you know the direction of the market, we want to find stocks that are highly likely to move in the same direction. So just trading the stocks you know or listening to gurus on TV, it's not the best choice. We want to find stocks that are already in uptrends when the market's rising, bad stocks that are in downtrends when the market is falling. The paycheck system saves a lot of time. We look at two main things: fundamentals and trend analysis, or looking at the graphs. We have pre-built searches that we use here at VectorVest that'll save you a lot of time. Next, we move to option selection. We want a way to select the best ones for option trading. Every stock will not have a proper option paycheck trade. That means even though the stock may look great, you may not have the perfect options paycheck trade. That's part of a good system. We want to seek out those options that are very high volatility. That leads premiums to being extremely expensive. Now, remember when I talked about what if the stock makes a sudden move? 99% of stock sudden moves are based on earnings. We're going to avoid earnings to have a better chance of avoiding those huge unexpected moves. And then finally, expiration. We want to make sure we're in that 21 to 45 day sweet spot. Now it's time to set up the trade. We want to pick the one that has the highest probability of success, and every strike price has a different probability, and we have to balance that by risk and reward. What we don't want to do is have a trade that has an 80% chance of success, but every winner makes 100 and every loser makes 800. Even if you're 90% correct, you're not going to make money that way. And that goes back up to option selection as well. Not every good stock that you find will have a good income trade. We need to know how to set these things up. Now, before you place a trade, I want you to know what to do if the trade goes for you or against you. I don't ever want you to be sitting in a trade feeling frozen like a deer in the headlights. Our paycheck system has rules to take profits at predefined levels, just like you saw with Take-Two. We have rules to adjust trades to minimize losses in case the trade goes against you. And we have that hard exit. We exit the trade if the stock were to surpass the strike price of the option we sold. I set these orders ahead of time with my broker. That way I can make this as unemotional as possible for me. We mechanically use this system each and every week to generate income throughout the year. So if you want to start implementing this system in your portfolio quickly, I would love for you to join our Options Paycheck experience. This is the most comprehensive program for generating consistent income using option spreads, even if you've never done this before. After going through the experience, you're going to know exactly how calls and puts work. Along with all the fancy terms, you'll never have that fear of options. You're going to have clear signals telling you when to trade bullish, bearish, or even not to trade. You're going to be able to identify the stocks that are the best candidates for this. We're going to set up income trades that give you a base level of 70% success. We're going to have a trade management game plan in place prior to you taking the trade. You will know what your loss, your gain, when to exit in any scenario. We're going to show you how to confidently enter and exit trades with your broker, and we're going to help you implement that system to help you safely and consistently generate income. Now, the course is 8 modules long, and we made them so each module builds on the one prior. We begin by building a strong foundation with options, which is great for anyone who is new to options or maybe just needs a refresher. We then go step by step through the 5-step system, and we finish by showing you how to place the trades with a broker. As you go through the modules, you're getting closer and closer to that end goal, which is a system for consistent income. Now, we put everything you need into a checklist so you never miss a step. When someone's first starting out, it's always comforting having that security blanket. That way you make sure you did everything right. Now, by placing trades with your broker, that can be intimidating, right? So in addition to some videos we have with several popular brokers, I also put together some click-by-click directions for TD Ameritrade's Thinkorswim. That's what you're going to see me using through the course, and that's definitely help if you use that broker. And again, we also have some other broker videos out there as well. Now, we offer a 100% money-back guarantee on the course. You can go through the entire course, and if you're not satisfied that we taught you how to profit using options, you just have to notify us within a week of finishing the course, and you can get all your money back. There's completely no risk. All we ask is that you give it your best effort. Come to the classes live, watch the recordings, it doesn't matter. Do the assignments, because I know if you do, you will see these results. The reason we have such a tight refund policy is because we only want to get those and attract those who are incredibly excited to jump in, do the work, and get the results. Here's a look at how we did last year. I trade with a real money trading account with my clients, and each week we placed live trades together. Now, last year was a tough year for the market, right? The S&P was down 19.5%. The Paycheck system we use made over $28,000 last year in our account. That was a little over 35% return. The capital needed for this would have been about $75,000. Now, let me also tell you a couple of the bonuses you get. Bonus number 1 is what we call the Mastery Package. The Mastery Package includes module by module mastery sessions. Each week, you'll have 2 mastery sessions, one dedicated to each module to help you master the course material. Plus, on Friday, I'll have an additional live Q&A. That means you'll have 3 live sessions each week, giving you plenty of opportunities to ask questions and get help. The Mastery Package also includes private, dedicated email support with me and my team. And additionally, if you don't already have it, we're going to give you access to both VectorVest and the Options Pro software during the 2 live months of the curriculum. These are the best tools on the planet to help you implement the Paycheck system. And with that Mastery Package bonus, you're going to have the tools and the support you need to master the techniques taught in the course. That way, you're ready to place your first income trade in the shortest time possible. Now, speaking of that, our second bonus is what we call the implementation month. You're going to get access to our live trading sessions. Now, during these sessions, you're going to watch me find, select, set up, and place trades in real time. Plus, I'll show you how I manage my existing trades each week. This is a huge bonus. You'll see how the Paycheck system works in action. You're going to see it follow along. You can even use your own account if you want to. I'm also going to hold live office hour sessions twice a week. We're going to walk you through the system step by step in real time. Our past students have said this is one of their favorite parts of the course. Watching that repetition really helps cement the concepts and the process for them. So, if you order before Monday at 5 p.m. Eastern, instead of paying the $12.95, you can get the course for $9.95. That means you're going to get the full course, 1 year of access to the course, the Mastery Package, the implementation month, 2 months to use the VectorVest and the Options Pro software during the live months. That $9.95 price will only be available to those who register before Monday at 5 p.m. After that, the price goes back up to $12.95. To order, simply go to www.optionspaycheck.com, get yourself registered, turn 2023 into an income producing year. I look forward to seeing you in our class starting in May. Have a great evening, everyone, and thanks for your attention during our presentation. Take care, everyone.